Good morning, everyone. Welcome to this update for global stocks and commodities for the 1st of April. This will be a shorter video today. I'm sure everyone's got plenty of other good things to do over Easter than watching lengthy market videos. So I'll just keep very much to the relevant points. The title of this week's video, and I'm seeing this a lot through the people that I'm communicating with, is the sense of getting too close to the market and thinking too much about the short-term movements. So really the message this week is to try and avoid that really short-term thinking. We've got some very volatile price movements, and it's better just to step back and just let it play out, particularly if you own good assets. So let's jump in and have a look. Just want to have a look at the current market status, review the charts, and just repeat a message that I provided last week, and that is there's a lot of people when markets get negative and the media gets negative, just want to look at the downside all the time. And I've had a few comments along those lines that that I'm habitually bullish. Well, gee, that's worked pretty well for the last few years. And I'm also very open-minded. Those that have been watching this video for more than a short period of time would know that at the start of 2016, when the market actually broke down, that I signaled a significant change in strategy and an exit from the market. Now, that didn't follow through. It only lasted a few weeks and then turned around and went back up again. So I'm always open-minded to what the market's telling me. So I've only remained bullish through this whole period because that's what the market action has been indicating, and secondly, there is no reason to be negative. So the possibility that this might develop into some massive trade war and everything's going to fall apart is just absolutely speculation and is incredibly unlikely to happen. So don't allow yourself to get drawn down into that sort of vortex. If you're looking at the normal stock and commodity trend update, and portfolio analyst last week looked at some of my favourite Australian growth stocks and what I regard as the unbreakable themes for the long term in the US market. And I think that edition of portfolio analyst was very well received. So just a bit of a perspective on the markets. There isn't really a flight to safety. So again, if you put aside your predispositions and what the media is trying to tell you, you've just got to look at the facts. And the facts are that there isn't a flight of money to the traditional safe havens. Consumer discretionary is still showing it's one of the strongest relative sectors in the US market. Now, if there was a flight to safety, then I can assure you that consumer discretionary is one of the first sectors that's going to get hit. The tech sector, a lot of people are making a lot of noise about the fact that the tech sector is corrected. Well, guess what? The tech sector has been the strongest sector for the last 3 or 4 years and is just taking a breather. This is perfectly normal. And when it gets a sector gets as far ahead of itself as tech did, along with the whole market in January, then that correction is going to be a little bit more volatile. So I see nothing other than quite normal corrective market action in what's going on at the moment. So the swings are violent, but we're in an aging bull market, which still might have some period of time to play out yet. So this is fairly standard for this stage, particularly when markets get ahead of themselves. I get a little bit of flack from time to time from people that just think I'm habitually bullish and that's all I can see. So I don't have a problem with having a basically bullish orientation. I just don't give into emotional short-term views, which I think is all that the people that are negative on the market have done for the last few years, and they've been proven to be wrong over and over again. We still have, this is the facts, we still have record US profits, and we've actually got strengthening outlooks. Guidance is being raised at a higher rate than has happened over the last 3 or 4 years. So, that's the facts of the matter. American stocks, the US index, the S&P was higher by 2% across the week. So despite the volatility in a short week, the market was 2% higher. And when it's all said and done, it's only down 1.2% year to date after two poor months in February and March. So I don't really know what all the fuss is about. And again, this comes back to the message of this video, and that's just don't get drawn into the short-term look at the market. Yes, the market has been a bit ugly in the last 6 to 8 weeks, but if you look at the market as a whole for the year, 1.2% is not far off being flat. So nothing too dramatic in the market at the moment. Many people are prepared to ditch technology because we're seeing some significant pullbacks. But again, let's be realistic about what's going on. Facebook has got their problems and they're stock specific. Tesla, if you want to include them as a technology stock, and they sort of are in a way, well, they've got specific stock issues that they're dealing with. But if you look at Amazon and Google, yeah, we saw some sharp pullbacks, but look, they turned around on Friday, and so far it's only been a couple of days. The fact is that the strongest earnings growth remains in the technology sector. That's where it's been, and that's where the strongest earnings forward guidance is still. So if you want to go out and ditch technology at this stage, then do that at your peril. I believe a lot of investors are thinking through their hip pocket. They've lost some money in the last couple of months. They've got very negative, and they're just taking a very, very short-term view of the market. And that's just not how you succeed in the market. When you look at some sensible analysis of this potential trade tariffs issue, I saw some very good analysis a couple of days ago, and it showed that really the economic impact of these tariffs, even if they don't get watered down, which is still pretty likely, because the Trump administration is making exceptions left, right, and centre already. The economic impact is actually quite mild compared to the overall GDP. It's not actually a big deal, even though the press is making it out to be a huge deal. And I don't think Trump or his administration are silly enough to shoot themselves in the foot and really escalate this trade war. For me, the fingerprints of program trading have been all over the market now for several weeks. You can see it in the way that the prices open and then close day after day. So there's not much doubt that this market is just being swung backwards and forwards by the the main trading platforms that benefit from that sort of fluctuation, and it'll eventually settle down. The US dollar was higher for the week, and it's got a bit of a slightly positive orientation to it. So let's jump in and look at some charts. So this is the S&P. You can see we're at the bottom of this rising trend channel, and it still is a rising trend channel. The 200-day moving average is still heading up. It hasn't rolled over yet. The price has not penetrated the 200-day moving average. And I refer you back to all the videos that I do 4, 5, 6 times a year where I look at 2000, 2008 and what the signs are that the market is starting to roll over. And there are just no signs of that at the moment. Now, anything's possible, and this market could break down and form a lower low, but that doesn't change anything until the market starts to trade below the 200-day moving average for probably a period of at least 4 to 6 weeks. And then you can start to think about a bit of a change of character in the market. But at the moment, we're at the bottom of a rising trend channel, and there's no reason to think that this rising trend channel won't continue, because certainly the fundamentals do support that. If we look at the NASDAQ, so this is QQQ, yes, we've had a bit of a sell-off, and it's got a lot more volatile since the end of January, but we've still got higher lows, and we formed a higher high in March, which the other indices didn't do. So I'm not writing tech off at this stage by any stretch of the imagination. Let's look at the US dollar. Bit of a slightly short-term positive orientation. We're still in this basing pattern, but you can see that we certainly have a higher high and a higher low here. So the US dollar perhaps poised to move higher. Just while I'm here, let's look at the Australian dollar. So the Australian dollar has been going the opposite way. We're now down under 77, and if you if you look at the long-term fundamentals, when the interest rate differentials were in the same sort of vicinity that they are now, and if the US continues to raise rates and the RBA does not raise rates, then the last time we were in this situation with interest rates where they are in Australia and America, then the Australian dollar was actually pretty close to 50 cents. Now that's just one factor, but just to give you a bit of a sense of where we are, it's very difficult to justify the Australian dollar being where it is at the moment. Now let's take a look at the Australian market. So this is the ASX 200 on a weekly chart, and you can see that we broke down 2 weeks ago, and that was confirmed last week. And with the way that our banks are looking, so if we look at the Aussie Banking Index, we've broken this is a daily chart, but we've broken a key support level on the Australian Banking Index, and there's just so many fundamental headwinds for the Australian banks that it's really hard to see them being able to get back into an uptrend and really being able to avoid a downtrend, which is really what we've got now. We've now got key support broken. I think we'll get a further move to the downside. And that's going to make it very difficult for the Australian ASX 200 to get back above 6,000 points, in my view. So Aussie stocks down to 76.8. We were down another 60 points. There'll probably be a bit of a rebound on Tuesday when the market resumes if the US market goes okay tomorrow night. But we're basically confirming a new downtrend. Precious metals, gold was down $21 to $13.26, but that was largely currency and a bit of a response to the calmer conditions. Gold did spike up a bit when there was a little bit of fear in the market, but that's sort of calming down now. Precious metal stocks, there's just nothing happening there at the GDX level. Just remains anchored at the bottom of the range. And as I've been pointing out for quite a number of weeks, the Australian gold market, the Australian gold producers are, to my mind, are the strongest gold stocks in the world. And certainly the Australian speculative gold market is showing some signs of life as well. So a lot more benefit and activity in the Australian market. Commodities, copper was up just a touch to 302. Crude oil held on very well considering that inventories went up again. So crude oil looking pretty good and still holding around the $65 mark. And if I was to pick a direction, I would think that crude may move towards $70 in the not too distant future. But look, energy stocks not really responding yet. As we'll see if we look at XLE, which is the main energy index for America, you can see we had quite a run up at the end of 2016. The ETF fell again from 78 to 62 throughout 2017. We then had a really nice run up, which was anticipating the move up in oil. That has now fallen all the way back again. But if oil does continue to hold this level of strength, then I believe that the next move in the energy sector will be to the upside. But I certainly wouldn't move on that until we actually see some substance around it. There's the spot copper chart. And just wrapping it up, look, this is a time to wait and watch. Trying to trade this very volatile market on a short-term basis is very, very difficult. So my advice is just sit back and relax and watch the action, let the volatility settle down, and if you own good assets, then short-term price movement shouldn't worry you in the slightest. Portfolio analyst this week. Again, I'm on the hunt for bargains. In this sort of market, it always throws up great bargains, and this is an opportunity I think that's building for the medium term. That's it for this week. There's my contact details, and I trust you're having an outstanding Easter break. Talk to you next week. Cheers.